Welcome to Subramani. I'm going to talk about how I invested in the not even late 70s, let's say early 80s. And very funnily, I realized what it is called maybe 20, 30 years later, right? So I didn't know the terminology that was applied to that. People, all of you have heard of EPS, right? Earning per share, and you have also heard of this word called earnings yield. How much is the dividend that how much is the earning that you are getting per share that you're for a share that you're buying, right? So suppose a company is paying you 5% dividend or 5 rupees dividend, which is 50% dividend on a 10 rupee share, and the share is quoting at 100 rupees, it means you're getting a 5% earning yield. Now 5% earning yield looks good for people to buy, but I in the 80s would not look at the earnings yield. I used to look at dividend yield, because for investor, what is the dividend that you get is far more important. Look at companies like MRF, they just would not pay any money, right, for a very, very long period. No bonus, no rights, no nothing, no great dividend payout. So it was a horrible share to hold. I have no regrets. I bought it at 800 rupees and sold it at something like 79,000. It's gone up further, but I am thrilled with the return that I got. However, that was not my style earlier. I used to look at how much is the return that I get in form of dividend. So for me, the dividend yield was very important, because I must have been in class FYBCom or something, just after class 12, and I had to choose between keeping money in fixed deposit in companies like pressure cooker appliances, which is the current Hawkins, versus keeping money in shares. And I found shares like say Hindustan Unilever, HDFC available at a discount to the share price. 100 rupee share used to be available at 96 or 97, and I used to say, wow, fantastic, I'm getting a better return in this than in a fixed deposit. That is the only driver that I had for doing that kind of an investment, and believe me, I found very good shares. I found Apollo Hospital available at 9 rupees, and it used to pay 10% dividend. So I used to get 1 rupee on 9, which was better than the fixed deposit return that I was getting. Maybe I was getting 12-13% fixed deposit return. So I knew in a year or two this would make up, because the underlying share would also appreciate. That much I could understand with my limited knowledge of investing in during my BCom. Much later, I realized that Warren Buffett calls it the equity bond way of investing, where he says that you should look at the dividend yield that you are getting, plus the potential appreciation of the share, right? So unlike his teacher Graham, Buffett was looking at how much return he is getting, rather than saying, is it cheap enough to buy? So different methods, but I was not looking at earning yield. I was looking at dividend yield. Today, if I talk about DPS instead of EPS, people are going to laugh and saying, how does it matter? No, it does used to matter for me, saying the dividend that I get is the only thing I control. Today I look at it more philosophically and say, if the company is managing the money better than I can manage it myself, even if the dividend payout is less, it doesn't matter. Let's say the company is getting a 15% CAGR on its capital that it is employed, on its ROCE, RONW, whatever. It is getting a better, or even on all the equity that it is, or all the funds that it is employing, right? If it is getting a 15% return, and its cost of funds is 9% or 10%, then they are doing a much better job than maybe what I could do. So then I don't mind if the dividend is lower, because I know I will get a dividend plus the appreciation that will happen in the price, because of the retained earnings also doing well, right? So today I am far more philosophical. Otherwise I would never have been able to buy a Zomato or a Indigo, because they are very busy using the money that they are earning and flowing it back into the business, right? So some of these businesses you will never be able to touch unless you look at it holistically and say, are they using the money better? So what are the things which I used to use, and what was important to me? Important to me was the dividend yield, how much is the money that I am getting. It had to be very near the fixed deposit which good companies were giving. And good companies, Hawkins was considered to be a good company. It used to be called pressure cooker appliances. So some of these 2-3 companies, I think Larsen and Toubro used to accept deposits, Bajaj, Tata Sons, they all used to accept fixed deposits, and to me though, that was the comparison. Of course, Buffett compares it to GSEC and says, is it giving a good return? So for example, today, if you are getting 7% on a GSEC, approximate return, and if you are getting 5% on in a company which is 5% dividend return, I would still go for the 5% return, because I know two things: the yield will keep increasing. 5% may increase by 10% next year, which means it becomes 5.5 on my cost, and then it will become 6, and then it will catch up to 7, and by the time maybe the dividend, the yield on G-Secs may have come down to 6. So somewhere around the G-Sec is good enough for me. I don't have to be 1% more than the G-Sec. That's far more difficult to find. Of course, 2 years ago we found a lot of PSU available at fantastic yield, but before that, it is really honorable to know that this is the way Buffett also invests, and that is what he is looking for in his ideal company. So what would be my ideal company, and or rather I would look at what would be Buffett's ideal company. Buffett was also looking for an increasing dividend yield. I used to look for an increasing dividend yield, consistently high quality of earning, right? So if it was a Carborundum Universal or a Apollo Hospital, the quality of earning was from the fact that every year it would keep increasing the dividend, or at least increasing the EPS, and deploying it well and deploying it further, right? A good ROE, because if the company is not getting a good return on equity, then there is no point in giving money to that company. At least it has to get, say in today's context, about 14%, 15% kind of ROE makes sense to me. A decent yield which is above or very near the bank fixed deposits or company fixed deposits, what I used to look for. Even today I would look at slightly less than GSEC, because I know it will make it up further. And the share price has to be fair, because and share price will be fair when you're looking at dividend yield companies. You're talking of value investing. So very good chance that the share price would be fair, because if the share price were to fall little further, it will become even more attractive. So I would rather buy. It's like buying Indian Oil at 77, 78, and then it fell to 70. I thought at 70 it was a better buy than at 77. So you know that this is a good way to buy, but beware that you can get caught in a trap and miss some good shares. For example, when I bought Apollo at 9 rupees, at 135 I told myself, this is a 15 bagger, how much more can it go up, and I sold. It's a different thing that I still have Apollo, because I bought again, sold, bought, sold. I still couldn't believe the price could go up so much. So to convince myself that it is a good share, and I've come down to very little, but of course I own some through a fund which is a pharma fund, right? So increasing book value means when the company keeps reinvesting the money that it earns. So if it earns say 10 rupees and it pays me 3 rupees as dividend, I am very happy with 3 rupees dividend, because I know that 7 rupees is getting used better, because the company has a 15% ROCE, right? So that money going back is being managed better. So to me it doesn't really matter. So which means again coming down to ROE, if the company does not have a good ROE, I don't even go anywhere near it, unless of course it's a startup and it is just started to do business. Then I don't look at any of the ratios. Then I only look at, are they building market share, and if the answer is yes, like a like Indigo or like Zomato, I'm very happy investing without looking at any of the numbers. I keep explaining this as like if you're sitting in a stadium and watching a match, you don't really need the scorecard. Once in a while you may look at the scorecard, but the fun is in watching the match, not in watching the scorecard. So you are looking at the ROE, which is the net income divided by shareholders funds, which means all the funds have been there, your debt, borrowing, everything, sorry, your debt, own money, everything. So return on shareholders equity has to be a good number. So which you come at the EPS and say, okay, this is a good number to look at, but I used to look at DPS rather than a DPS. Additionally, I prefer companies where they retain their earnings and not pay dividend. That's also fine. And I look at companies with growth prospects, companies where there is less competition, companies with a long dividend paying track record. To me, 15 quarters, which means 3-4 years of regular dividend paying, is very important. So a Colgate or a Procter and Gamble or anything would fall into it, but they would never be available cheap to say the dividend yield is good. There you have to depend on growth, but typically a company has to be retaining some of its profits for its further growth. That was also important, and that I realized a little later. Over the past few years, we have seen interest rates being low, right, and bond yields being low. Therefore, it is easy to find companies which have a good earnings yield above, say, above your threshold limit. But be careful, as interest rates increase, this return may fall, and their return on shareholders equity might keep falling. So be careful about that. When all these criteria are met, it is a good chance, there is a good chance that the price would be fair. Like 70 rupees of Indian oil was a fair price, or 119 rupees for a Coal India was a super fair price, 150 for SBI was a super fair price, right? So sometimes all this happens, so be careful. That's it. That's how I used to invest, and I realized much later that Buffett calls it the equity bond. Very clear to understand, right? So if you get a bond at 5% yield and dividend yield share at 4%, which is preferable to me, it is the 4%, simply because I know in a couple of years the dividend will increase and the bottom, which is the share price, will also increase. The overall return that you get, even with just a 4% dividend yield, could be much higher than a 5% yield in a bond. Today, of course, dividends are taxed, but the capital gains will be taxed at 10%, whereas the total dividend income, or rather the total interest income on the bond, would be taxed at current rates. So advantages, disadvantages, I prefer equity bond rather than a regular bond. Thank you.